Hey everybody, how's everyone doing today? Good morning, good afternoon, happy holidays. Want to thank you all for joining us today. I'm really excited. I've got a special guest I'm going to introduce you to in a moment.
Hey,
I see a lot of people still coming in.
this is
So if you
great.
could please do me a favor, if you don't mind typing in where you're tuning in from. This is a great big world, and every time I do these events, I love to see where everyone is tuning in from. I'll read some of these off: Austin, Texas, Pennsylvania, Kansas, Bend, Oregon, Maryland, New York City, Denmark. Hey, Denmark, I was just over there. Vermont, Hong Kong. I'm waiting for my buddy from Papua New Guinea, San Antonio, Texas, Thailand, North Carolina. You get the picture. Lots of people all over the world. France. Hey, Bruno, good to see you, buddy. All right, I'm really excited today because I haven't talked about stocks and options like specifically as a topic for quite some time. As you guys know, live trade room and I'm day trading a lot, but stocks and options are such a huge profit potential for traders. And one of the things I love most being the backpack trader and the whole message of my company is trading less for a better quality of life. Trading is a business. It's fun. We love it. But let's face it, it's also um, it's work too, right? And I like to do other things, and I like to get away from the markets and trading less and making more to have more time to do the things we love to do is what the backpack trader message is all about. And stocks and options play a big role in that. And it's been a phenomenal year. 2022 is coming. I'm hoping that we make this the best year ever. We need it.
We
We're
will.
due for it, right? So that's we're going to be doing more of these kind of round the coffee table discussions just to discuss trading as part of the Trade Hacking Club. Gotten a lot of questions about what the Trade Hacking Club really is and what does it mean. And I got the idea, well, the word hacking, it's kind of it's come up recently. It's risen in our vocabulary and a kind of one of the new age words in our modern world. But what it really means is dissecting something and figuring it out so that you can then reconstruct it and put it to work for yourself. So trade hacking is about figuring out what's working and then how we can model our own trading after it and be successful as well. So it's not, instead of reinventing the wheel, we just reverse engineer and then re-engineer stuff that already is proven to work. And that's a pretty good message. It's right into the backpack trader philosophy. So that's why we started the Trade Hacking Club as a way to get really good traders in our community together to put their heads together and share ideas. And it's working. I mean, if you guys are on our Discord channel, a lot of you are interacting on that. And if you're not, you're certainly invited. It's a free community, and you should come on board our Trade Hacking Club Discord channel. If you guys need the link to join it, you'll find it on my YouTube channel, Backpack Trader. All our live streaming events, the trade room that we do live on YouTube, if you look in the description of the notes, you'll find a link to join the Trade Hacking Club. And if you guys want, I could type that in later and you guys can join it if you haven't already. So trade hacking is a big deal and it's something we're going to be focusing in on a lot in 2022. So with that in mind, a second, guys. Start the recorder. I need 8 hands sometimes over here at my desk. So let's see. Yeah, hey, Romulus, maybe you can mute your mic for a moment because we're picking up a lot of sound from you. Um, okay, so people are still coming in. Great. Welcome, everybody, for joining us today. I'm going to share my screen. Today we're going to talk about stocks and options, particularly as we roll into 2022, what the opportunities are. And let me get to my sharing. Okay, just going to give this a chance to pop up. All right, so you guys can see my screen now, right? I just want to talk to you a little bit about some of the things that have happened recently. And then I'm going to introduce my good friend Romulus, who's got a lot of amazing things to share with us today. I'm really excited to hear his presentation. But the other day we were talking on our trade hacking club, and this happened. This is the spider. Let me blow this up and make this bigger. I like to use this as a proxy to see kind of what's going on in the markets because it's the ETF for the S&P 500, kind of trades alongside the S&P. And I noticed what appears to be a head and shoulders pattern. And this is a pretty strong pattern. It's a pattern that you don't want to get caught up in because it's a big reversal pattern possibly that's forming, and you can get chopped up getting long, getting short. I avoided these trades because I saw this happening, and right around this time here, I'm thinking, okay, this could lead to some downward pressure, and we needed to see a break below the neckline. Does everybody understand the head and shoulders pattern? It's a pretty standard pattern. It's the first pattern I learned as a trader back in 1992 when I shorted the British pound, kind of launched my career, and the backpack trader was born. I'm sure you all heard that story by now. But anyway, it never did break the neckline. And instead, it broke up above not only the right shoulder, but the head and the left shoulder. And now look, we're at nosebleed levels, making new all-time record highs. So just because a pattern is forming doesn't mean that it is a legitimate pattern, right? We have to let the price action prove itself to us. Nobody knows what's going to happen next. Now we're looking at the counterpunch trader. I love to use this strategy for options trading. And being the end of the year and having it's been a stellar year for me, super profitable, and I wasn't in a hurry to give my money back to the market. And I believe that there's a risk that this rally is fizzling out. Like, I don't want to be one of the last buyers near the top before it comes down, and we'll discuss this more as we get into this presentation. But I'm flat right now. I'm not interested in these signals. Now, this can come up. Maybe it keeps rallying, and it could. We're in a strong rally, and rallies continue until they don't. But I just wasn't interested. And another reason why I'm not interested, and I'm going to tell you why, there's a few things here. First of all, when we look at some of the other markets, let's look at the Qs. The Qs still have the makings of head and shoulders, don't they? You can see it right here. Now, maybe the S&P is leading the way and the other markets are going to follow, but until I get some corroboration, I'm just not believing the rally. And whether I'm right or wrong isn't even the point. I'm letting price action tell me. I'm trying to listen to what the market's trying to say to me, right? And so I don't believe it yet. And also, when we look at some of the other indexes, let's look at the Dow Jones. You don't even have a real head and shoulders here. I don't even know what it is, but it still hasn't broken out to new highs either. So you got resistance right overhead. It might pop through. Counterpunch put it in a long trade, but I just don't believe it yet. And I'm not in a hurry to give my money back, and I don't care if I miss a trade, right? So this is just maybe the art to trading, but here we have what looked like a possible head and shoulders, and maybe the right shoulder is forming here again, I don't know, but the Russell also is lagging. Only the spider is broken out. Now the spider might be leading, and maybe everything will follow, but I'm suspicious, especially this time of year, right? So anyway, I just wanted to point that out. Be careful right now, because if you remember in 2018, we saw these patterns form and the market just kind of went up and down for a whole year almost. I don't even know. It was many months, and anyone trying to trade in there didn't do very well. All right, so I'm looking at other markets instead. For example, one of my favorite markets to trade options, and I'm gonna explain this to you really quick, is USO. And I like it because it's a lot less money and I could buy more options, which lets me scale out at different targets. Again, I'm just using a simple counterpunch trader technique, but this would work with a number of strategies, but it works well with counterpunch. I just got into this trade here. It's set up. The whole thing's right there, 53.26. I'm looking to buy a slightly in the money option, right? So I think I got, yeah, 52 calls. I bought April, that gives me several months. So I'm looking for a lot of time. I'm willing to pay more for the option to have more time. Because if I lose, I'll sell the option back and get more money back for that loss. In other words, if this were to come down and hit my stop, I'd have enough time to sell the option, which would still have a value, and I'd recapture some of the premium. So look, it popped up and it just barely missed target one, like by not much. Target one was 55.89 and it came up and it hit 55.67. I mean, it literally missed by 22 cents. Well, now I have to make a decision if I'm going to hang on to the whole position or move up to a break even or cut my risk. I'll have to decide what to do. If I was watching this when it happened, I would have taken profit a little bit off the table because I'm not going to fight over 20 cents, right? But I wasn't watching it. So there I am. It doesn't matter to me because this market just wins a lot, right? You follow counterpunch trader and you're just going to see winner after winner after winner, and it does really well. So it's probably due for a losing trade, to be truthful. But the USO is one of those nice markets to trade with options. And just to reiterate, you could buy the stock or the ETF, but I like to trade options because you get a lot of leverage. And if you buy options that are slightly in the money with enough time, then even a losing trade, you get a lot of your money back, and it really goes into your risk reward ratio over time. So this is the kind of strategy that I'm using and I will continue to use in 2022. I know a lot of people have counterpunch, and you could use the trade hacking club to ask questions, and we'll continue to discuss it and what have you. All right, so we can come back to this in a little while, and I do see some comments that some people from the trade hacking club and Discord had a hard time getting in, and I'm going to go and see if I can help them get in. So before I do, I'm going to pass this over to my good friend Romulus. I know a lot of you have been asking about him, and there's been a lot of interest in his work, and for good reason. Romulus started on Wall Street back in 1994. Now, I've never done anything on Wall Street except visit it and take pictures in front of the bull, although I did go up into the World Trade Center before it got destroyed. But Romulus worked there, and he traded a hedge fund until 2012. He's been producing research, and he's been this amazing teacher ever since. He's got tons of students. His main trading model he calls Firmus. It's earned double-digit returns almost every year. And in 2008, one of the second year in stock market history, his model literally made double-digit returns when everyone else was losing money. So he's someone to listen to. I'm really excited to have him. And in recent years, he's taught hundreds of traders, many different countries. He's changed their life, basically. So he's also a technical analyst who's learned from some of the fathers of technical analysis, like Ralph Acampora, Paul Desmond, and John Murphy. John Murphy, of course, is maybe known as the father of technical analysis. He's got that great book, many books, actually. So I'm really honored to have Romulus here. He believes in the power markets. He's able to teach his work to anyone who's willing to learn and who wants to improve their financial lives, which is all of you. Obviously, that's why you're here. So without further ado, let me pass this over to Romulus, and then I'm going to jump over to the Trade Hacking Club Discord channel and see if I can help everyone get in who's not in yet. And Romulus, let me just change presenter. Give me a moment here. and then I'll let you take over. I'm going to mute my mic.
Yes, thank you very much, Troy, and thanks to everyone who is coming on board in this holiday week. I hope everybody is enjoying their holiday, staying safe, and getting some time with friends and family. What a great time, though. It's been a tradition for as long as I can remember, going back over 25 years, to take the week off between Christmas and New Year, even though, it's common in the industrial and manufacturing space to close the factories down. Well, Wall Street is still open, but it does slow down a lot, and I like to enjoy that time. But one of the things I've always done in that week, in addition to all the normal holiday Christmas stuff, is I've taken some time to learn something new that is directly involved with trading, investing, and technical analysis. And maybe it's just an indicator. Maybe it's somebody's entire theory. Troy mentioned that I learned from a fellow by the name of John Murphy. John Murphy has a lot of the books that are used to teach technical analysis in the different societies and organizations around the world. John actually hired me in 2009 to trade his accounts for him. And as I was doing that, I realized that, God, a lot of the stuff this guy's taught, although I knew some of it, I didn't know all of it. So I've involved a lot of that stuff. John likes to, even today, he likes to talk about rotation. He likes to talk about correlation between different markets. Oh, if gold is going up, what does that mean for interest rates? Or what does it mean for the dollar if the dollar is going down? He likes to do a lot of that tie-in type of work. And I didn't think about it until, again, I was doing direct work for him, and started to delve a little more deeply into what he was getting at. Now, the main idea behind Backpack Trading and Trade Hacking Club is, yes, we realize this is work. Of course it is. But how can we do this without spending 90 hours a week? When I started at 67 Wall Street in September of 1994, I worked 90 hours a week. And I did that for several years. And I learned a lot about Wall Street, technical analysis, trading, investing, growing businesses within this type of an industry. But I don't want to work 90 hours a week anymore. I don't, actually. And I'm sure that you don't work 90 hours and you don't want to. But you can get caught and lost in this kind of thing. And that's not the theory behind Trade Hacking Club. It's not what we want to help you guys achieve. There was someone, a PhD actually, I started teaching him some trading in May. And 2 weeks into this, I realized that he was working too much. He was putting too much time into this. He was telling me he's staying up till 2 in the morning, 3 in the morning with Fibonacci's and Gann and all these different theories and ideas. And it was just, I really couldn't believe what was going on with this guy. Okay, too much work. I said, you're going to burn out. And then I'm not going to have you as a student, and we're not going to be together. We're not going to be able to work together anymore. That's not what we want here. We want to be able to have you with us for years and decades even. I measure relationships in decades. And so he started working less. And he started involving more of what else we can do in our lives. More time with friends and family. More focus on health, wellness, and longevity. And his results started to get better and better. In the last 3 months, he's had record results. His health is better. He's lost weight. He feels like, he tells me, he's added years to the other end of his life. And that's what we want to do. Troy and I are here to help you guys get better at trading and investing. We want to be able to help you create a plan for yourself, find a style and a system, and whether it's trading natural gas futures or trading natural gas futures and options in the oil market, as Troy just described, or some of the things that I do, and I'll show you that in a moment. Whatever it is, you want to remember that all of this, you have to figure out a way to fit it into your life. It's not the other way around. You don't fit your life into trading and investing, because if you do, you'll burn out. You won't be with us in a few months or a few years, or let alone decades. And that's what we really want. I still work with customers and clients that I've had from the late 1990s. You believe that? Still today. I'm still consulting and advising and producing research and teaching these people over 20 years later. And that's what I want for all of us. I want this to be a relationship that we can look back 20, 30 years from now and say, we all benefited from this. Okay, we're all better, smarter, and getting highly profitable results from this combination. Now, there's a few things, universal truths, that I believe are going to be with us forever. Because let's face it, what are we dealing with here? Technical analysis. And if you guys should be able to see my screen, which I have up on the S&P 500 trading view, but I'm going to need to show, let's see here. Can you guys see my screen?
Yeah, you're good. We see you now.
And you see S&P 500, SPX, right? That's the screen because I have two screens overall.
Yeah. Yep, we got you.
All right, fantastic. Well, great. So I'm happy about that. Now, there's a couple universal truths that come with trading and investing and fitting this into your lifestyle, fitting your plan into your life, not the other way around. Because you have to be able to do other things. You cannot spend 90 hours a week doing this. You'll be effective for a short amount of time, and then you will burn out. It happened to me. I'm sure it's happened to Troy, different parts of his career, and maybe it's happened to you. That's not what we want. But a couple of things are fairly effective across the board. A few main aspects that I'm always on the lookout for when it comes to trading and investing are, number one, extreme levels of overbought and oversold. Extreme levels of overbought, oversold. And negative or positive divergences. So extreme natures of overbought, oversold, negative or positive divergences. That's what I'm really looking for when it comes to the markets. Okay. Now let me give you an example, a live example right now. Now, this is IBM, individual stock. I don't trade a lot of individual stocks as much as I do ETFs because I don't want to get caught up in individual stock risk. I find that I can make my goals every year without having to take on that extra risk. So obviously, why would I? But there are cases when individual stocks turn out correct and they are the right play. This is one that could be in the making right now. Obviously, the stock has gone up an awful lot since this bottom right here, as you can see on November 26th, which, by the way, was the day that the news came out about the Omicron from South Africa. That was the day after Thanksgiving. But you notice the rest of the stocks got hit that day, but IBM barely down, and that was the low here, at least for the last several months. Then it starts to go up on a massive climb from that point till hitting a new multi-month high today and just about closing this gap right here. It seems like it has. Okay, yes, it has closed that gap right about here. Okay. So what am I getting at with this stock? This is a possible shorting opportunity for the short term, by the way, not intermediate or long term. This is a possible short term shorting candidate. Why? Because look, you have an extremely overbought condition. My indicators that I have up here are the RSI 2, the CRSI, and the RSI 14. These are all similar in nature to other oscillating type of indicators like a MACD, for example, or other stochastics that have the ability to show you when something is moving to an extreme level. And the reason I don't have a MACD up here is because, again, they work in very similar levels and they work in similar areas. I've just become more accustomed and comfortable with using RSIs as opposed to MACDs. But it's at 99 on the RSI 2. What does that mean? Well, it means it's massively overbought on a short-term basis. It's at 78 on an RSI 14 down here. Again, massively overbought on an intermediate term basis now. Okay, and the CRSI, by the way, this indicator was invented by a friend of mine, Larry Connors, which is a combination of the RSI, and he has a 3-period, a 2-period, and a 100-day look back. Okay, so he's kind of smoothing it out. It tends to be a little more sensitive than the RSIs at either a 2 or a 14 period. It can give you a little more of a lead look, but keep in mind, there's always trade-offs in trading and investing. Anytime you have an indicator like that, what does it mean? It gives you a little more lead time, that it doesn't, the accuracy might be a little bit less, which is why I combine it with the other two, okay? So you'll often see this will turn down, price will still continue higher, which is that negative divergence. And that's what we're missing right here. We have the extremely overbought condition on IBM. This window, this gap is now closed. We know this stock has been very weak for very long. If I move it to a weekly over here, hang on, it doesn't always pull up properly. So the stock has underperformed the NASDAQ and the S&P 500 for quite some time. You can see how far back you have to go. I mean, the stock's been stuck in down the neutral for several years. So it's massively underperformed the stock market for quite a while. So relative strength wise, it's a big loser. And now it's been coming up. Okay. And even looking at that on a weekly basis, you can see how really overbought the short-term indicators are. This is due for some kind of a pullback. But what is it missing? It's missing that negative divergence. Remember what I said, we want extreme overbought, oversold, and typically correlating and corresponding with a negative or a positive divergence. And that's what we don't have right now. IBM continues to go up for another day or two. The CRSI will most likely turn down first. If the momentum starts to drift and change, then you'll have that negative divergent behavior that can begin a shorting operation. And the key, though, is your money management. And that's a little beyond the scope of today's conversation. But I'm going to be with Troy, the Trade Hacking Club, the backpack trader community for decades to come. So we'll have plenty of time to discuss further what and how we can use money management techniques, trade execution techniques to increase the probabilities of success in a trade just like this. Okay, because there are tactics and strategies that I have employed for many, many years that do just that. And by that, let me give you an example of what I'm talking about here. Okay, right now you should be looking at my spreadsheet. Okay, this is my main stock trading model called Firmus. Why do I call it Firmus? Similar to why I call myself Romulus. I love it. I'm an ancient Roman kind of freak. When I was in college, I studied ancient European history with a concentration in ancient Rome. Probably as in depth of an amateur expert as someone can become in this field, and I love it. So I call myself Romulus, who was the founder of the city of Rome over 2,700 years ago. And this model is called Firmus, which means strong ground. Okay, strong ground. So this is 2021 results. See up 22%. You might think, well, Romulus, 22%. That's not so good. I mean, it beats the Dow, beats the probably the NASDAQ. It beats the Russell 2000. It beats all foreign indexes, but the S&P's up 27, so you're lagging. Sure, but I didn't have a 5.5% correction, not once but twice. Matter of fact, the biggest drawdown for this portfolio is 1.2%. That's it, 1.2% drawdown. That's it. And on the right, in the green is when a winning trade occurs, and the red is when a losing trade occurs. And you see that we have done 100 trades this year with 5 losers, meaning a 95% win rate. 95% win rate. And by the way, these are all ETFs. This only trades exchange traded funds. It does not trade individual stocks. So would you take, oh, and by the way, if the S&P 500 was down 27% instead of being up 27%, then Firmus would still be up 22 or 25. It usually does about 25% a year. It's down a little bit from its annual run. Okay. Would you take 25% a year no matter what the market does, regardless of market direction? A 95% win rate, which is a little bit higher. That's something I'm exploring. The win rate usually is 86%. So the return is lagging a little bit. The win ratio is increased. What that means to me is I was probably a little too conservative at times during my trading. So do you see how I took the data? And Troy, I know you're big on this, taking the actual data and interpreting that and using the data to correct a mistake and try to improve my results. The data are telling me that I was probably too conservative. Higher win rate, lower return than normal. I'll sacrifice a little bit of the win rate to get a higher return, but not too much. Okay, there's that balance, there's that line. I don't want to try and make 35 or 40 or 50% and a win rate of only 50%, because that means I'll have drawdowns that are unacceptable to me. Okay, and
Hey,
the one
quick
point
question for you, Romulus.
yeah.
So this is really interesting. It's fascinating. What an amazing track record. We all wish we had this. Are these trading just the shares, or are these including any sort of options trades with these particular trade signals?
Yep, I do trade options on the ETFs when it's appropriate. You see, Troy just highlighted a trade that he did with USO. Okay, USO is a very heavily traded exchange traded fund, and the options on that are, we can check them as we go. You see here, I'll hit up my options. Okay, and when I'm trading an ETF, and I have a universe of about 30 of them that I'm selecting as my candidate list. So right now I'm on CBOE, which is the main source of all options data, and I have the options chain for USO. Let's look at April. Is that what you said, Troy? April. So here are April's expiration for USO, and you can see that we have puts and calls, spreads of about 15 cents. Okay. If I go to January, I should see narrowing spreads. January 21st is going to be the main option to look at here. When I'm examining possible option trades, everyone, I'm looking at liquidity, so open interest, volume, and spreads, okay? Because I want to make sure I'm holding my ETFs for 2 or 3 days up to 2 weeks. Typically not more than 2 weeks and a couple of days. So these are not long-term holds. They are not intermediate-term holds. But I have to make sure that I can get out of them successfully pretty quick. And I need spreads that are fairly narrow in that regard. If I look at January 21st on USO, I can see that I've got plenty of options here on my options. I can do a 53 strike, already 1,700 open interest, traded 37 calls today. This one much more, 600 calls, 33,000 open interest at the 54. That's the one I want. Okay, it's got a 10-cent spread. I could put a bid in to buy some at $2.15, maybe get hit. Perfectly happy with that. Okay, perfectly happy. And I would say that about 20 to 25% of my trades that I do in Firmus are options trades. When I don't do them, there's a couple of reasons. Number one, the spreads. Here's a trade that I was looking at recently, shorting the country of Spain. And you'll see when I pull this up at the spreads and liquidity are not that viable in here. So we have January, which is January 21st. You can see there's a couple of them that haven't traded at all. Okay, there's no volume today in any of these, and the spreads are steep. Okay, look at these spreads; they're killer. Okay, it's too wide. This is not a liquid option. So I won't trade the option here. I'll just short the stock I'll short the ETF or go long the ETF, and that's it. But if I'm trading Qs, which we do plenty of times, well, that's a great ETF for options trading. Okay, let's go to January 21st, and here we are. Okay, look at that. There's thousands of them. There's hundreds of them that are trading today, and the spreads are fairly small. And here's 4 cents, here's 3 cents, and so on. Okay, that's a great one. So you just have to make an on-the-field decision. Now, there are people that follow my work in Firmus, okay, that do options all the time. They only trade options, and they don't care if they're getting involved in something that has a wider spread and less liquidity because they feel it's worth the risk. There are plenty of times when on the ETF itself, I might make 2 or 3% on the trade, 4%, 5% on my capital on the trade, but they'll make 15, 20, and 30% on the option. Okay, and maybe that's something that I have to include in my exploration of increasing my risk in an attempt to increase my returns this year. Okay, that probably will be something I'll have to do, increase the options trading. But I would do them with ETFs, okay, instead of individual stocks, because this model does not trade at all in the individual stock basis. But that doesn't mean that there are not great trades always presenting themselves, at least on some normal basis, a few a week, in the individual stock class, like IBM as an example. Okay, this is a great one. There was an example recently with this stock here. Okay, you could see that this is a major play for 2021. It had been a big winner for the year, and it was getting hit heavily, okay, for several days in a row. And then what I noticed is something fairly common. It doesn't go straight down. It has relief rallies or automatic rallies, as Wyckoff likes to talk about from back in his day. But you can see it reached extremely oversold. Again, that extreme nature. The RSI2 was under 1. The CRSI was down there at 1.46, extremely oversold. Okay, and then it gets a bounce, 5.6. So it goes up over 6% from that low in here before resuming its downtrend. And that's a great trade right there. Just a quick short-term play, taking advantage of an extreme oversold condition for a bounce. Or in the IBM case, what might be developing in the next couple of days is an extreme overbought condition and looking for a temporary pullback. That's where a lot of my work centers around, because I've noticed from my experience that this has a higher accuracy rate than doing what most people do, which is buy breakouts looking for trends. Okay, they buy breakouts looking for trends, and that's what a majority of the traders and investors are doing. That's what a majority of the teachers in the world are trying to teach people. But I am more of a counter type. Talking about counterpunch, I'm more of a counter type of a trader. Okay, I'm looking for opportunities that are presenting themselves from an extreme situation and then really revealing from the overbought, oversold, and the negative or positive divergences that are coming along with that. And it's a universal. You can take this and use it for the rest of your life, even if we never communicate again, which I hope isn't the case. But even if we don't ever communicate again, it's all you do is shop around for overbought, oversold on an extreme basis, and you have to be extreme, and then looking for a positive or negative divergence to correlate and correspond with that nature, you'll probably be doing better than you've done before, and you have something that can help you for the rest of your life. The rest of your life. And you can tell that it doesn't take 90 hours a week to do this, because I want you on the beach with your family. I want you hiking. I want you pursuing other professional interests or other intellectual interests, whether it's learning a foreign language or painting or anything else. You can't go through this and think that you can put 90 hours a week in. You'll burn out for sure. Okay, you will definitely burn out. So that's a couple of the things that Troy and I are going to continue to uncover and reveal to us over the course of 2022 and beyond. We're going to be presenting some specific details about, again, the money management techniques and the strategies and tactics that you can employ to increase your rate of return, to increase your win rate as well. Or again, if you're like me right now, you're looking at the year and thinking, hey, how could I have done better? Well, maybe I have to sacrifice some of that win rate. Maybe I have to sacrifice some of that low drawdown, because 1.2% is pretty low on a drawdown basis. Maybe I have to let that increase to 2.5 or 3, and the win rate drop into the high 80s in order to improve my returns, and maybe I can break that 25% barrier, because my goal is 25%. And again, that happens though regardless of market direction. If the market's up or down, I'm still making my money, so I'm comfortable with that. All right, so for the options though, I actually taught a class about the options back in the summertime that I have recorded, and Troy and I can talk later about getting that recording possibly into your hands at time in the future. But it's really about looking for the liquidity, the spreads, and what you want to sacrifice in terms of downside. Because remember what Troy said a moment ago, that he was buying the April. That April expiration gives him that safety factor. He pays more, but it's like an insurance policy. If you're looking for a January expiration, the options will be less absolute cost, the volatility will be higher, and your risk factor will be higher. Because every day now, that theta, or that time decay, is starting to eat at you even more aggressively. Okay, so it's just everything's trade-offs. Okay? Everything's trade-offs. But the ultimate trade-off here for us is, how do we increase our returns? How do we improve our efficiency? And also giving ourselves more time. Before everybody joined the call, that's one of the things Troy and I were talking about. How do we give ourselves more time professionally to still continue and bring everybody the maximum abilities that we can in terms of trading, investing, and ideas, but also allowing us to continue to live our lives, because we don't want to burn out either. If we do, then what's the point of all of it, right? So with that, I'm going to open it to some questions here, Troy, if that's okay with you. If anybody wants to get some questions in while we are still attending. And again, remember that I'm going to be popping into Discord on a regular basis starting next week. And we have many more conversations and discussions and talks that we'll be bringing to everybody over the course of the year. and we would love the opportunity to continue to serve you guys in this way. So very, very excited about that, and looking forward to a lot of continued work for the next several decades. So I guess what you should do now is just fire questions in. I think I have the question box open appropriately. I think so. And if
Yeah,
you ask,
let me just jump in. If we got a good list here, a lot of people have joined us,
yeah,
said hello, and you guys might have some questions on particular stocks or ETFs or symbols that you're interested in, and we could have Romulus pull them up and
mhm.
tell us what he thinks about it. So feel free, you guys, just go ahead and jump in and interact with us. And we're not going to be here that much longer. We're getting close to New Year's, and I'm still in the holiday spirit and can't wait to push away from my desk,
Right
actually.
on.
But we're let's finish this with a bang, guys. Let's see what's on your mind. Romulus, just whatever you see, feel free to
Yeah,
to
absolutely, absolutely. And I do this type of work frequently with my group. Matter of fact, on Thursday nights we do a Thursday night live, 4 p.m. to 5 Eastern, and it's just we talk about broad markets, indexes, sectors, subgroups, and individual stocks. Really focusing on, let's like a weather report for the coming week. And as you guys are looking at getting ready to fire your questions, I can show you what I'm talking about with that. So the S&P 500, as Troy mentioned, it was maybe setting up. You kind of see here something was going on, and then it breaks out. The low volume, of course, is corresponding quite with the holiday season. That is typical. Is it something that we should be leery of? What I have a problem with is, let me show you guys something here. And I'm moving this to a line because it is easier to see. Okay. So this is this is one of my greatest indicators. And for those of you who are sticking around today, you're getting a real holiday treat with this. Okay. So this is the percentage of stocks within the S&P 500. So the universe is the S&P 500. The percentage of those stocks that are above or below their own 200-day moving averages. Now, before I showed this to you, if I showed you the S&P and you saw that it was a new all-time high yesterday, which it was, and I said, well, go ahead and guess how many stocks in the S&P are above their own 200-day moving average. And again, you saw the S&P at a new all-time high yesterday, and you would probably say, oh, 85, 90, 95%. That's a great guess. But look at this. It peaked out here in April, okay, April 20th, 21st. And it's been locked in a downtrend ever since. Okay. It kind of gets stuck up here. It's hitting its head in this area. And it's at 71% today. Why isn't that higher? It should be. It should be a lot higher, actually. Why isn't that higher? That's something to think about. And it's like that for all the major indexes. You got the S&P, the NASDAQ is far worse. Less than 50% of all NASDAQ stocks are above their own 200-day moving average. And the NASDAQ itself is within spitting distance of a new all-time high. Okay, Russell 2000. 48% of Russell 2000 stocks are above their own 200-day moving average. Now, the Russell itself has also been quite a bit pulled back, so that makes more sense. But the one to be concerned about is the S&P. And if I go to 50-day moving average, same thing, peaked out here in April. And on the NASDAQ, only 42% of all stocks in the NASDAQ are above their own 50-day moving average. This should make you kind of concerned. It should make you open your eyes and think there's something going on. Now, another one. The number of stocks hitting new 52-week highs. Okay, again, the S&P had a new all-time high yesterday. This number should be fine. This number should be doing great. But look at it. Look at it here. May 10th it peaked. It hasn't come close to that number since then. Not even close. I mean, it can't even get back to the November 5th peak. It can't even get back there, let alone this peak here or the all-time or the post-COVID rally high there. And it's just stuck in this trading range right now. This is an awful number. And this is concerning for perma bulls or people who really have, the roses on their eyes here. These numbers are telling us there's something not right about this rally. Okay. But if I look at the stocks at number of 52-week lows, which crashed down here recently, it tells me that maybe it's not terrible either. Okay. And if I look at the Russell 2000, which is the real reason to be concerned, because this is where a lot of the damage has been. Okay. If I look at the Russell 2000, I could see a market that is still stuck in this trading range it's been in for almost a year, since early February. So it's 11 months. It's still stuck in that trading range. And this is indicative of the market overall. A lot of those SPACs, whether it's this company or this one, they go on and on. These things came public last year or earlier this year, and they just ran up to huge heights. But then investors and traders quickly realized that most of the stuff is garbage and most of them will be bankrupt in a year or two or three. And so they got hammered and they pulled back. But there's hundreds and hundreds of these things that came public late last year, early this year. A record number, actually. And that's what's polluting and diluting up the Russell 2000 and getting in the way. But we don't want to overlook an old market saw that if the soldiers are falling behind the general by too far of a margin, it's only a matter of time before the generals get shot. Okay? This whole market is being held up by these handful of stocks. All right, that's it. The whole entire market. Now, these will be the last to go. So I have a strategy that I'm currently involved in. I have a couple different trading models. Firmus is my main one, but I have a intermediate term model. And my intermediate term model is right now positioned just to take advantage of the characteristics of the market that really means the smaller, middle-sized companies fall out first, and then the big guys fall out last, and then the next bear market starts, which is typically how bear markets develop. Not every single time, not 10 times out of 10, but 90% of the time for the last 150 years, that's how bear markets begin. And I don't think this one will be any different. So there's ways and strategies and tactics that you can use to benefit from what are typical market characteristics, that being one of them. Okay, if you have other longer term stuff. Now, for those of you who are just heavily involved in trading, again, the futures markets, don't forget there is that correlation that goes on out there. I've heard a lot of people talk about what could be coming into a commodity super cycle, which we haven't seen for a long time. I'm not theoretically opposed to this at all, but we're going to have to see more upside action on price here in a lot of these commodities. Okay, gold is not participating. This guy has been losing trade for 16, 17 months. Oil did run up, but it's been pulling back, and we're going to have to see a lot more commodity type of things do well. Okay, now I am close to a lot of these things. I check out the charts all the time, and so we see that many of the commodity charts pulled back from highs back here in the spring, and they're kind of rebuilding themselves. But you look at corn, and this one has a nice little bowl shape that is positive. This is a bullish configuration right here. Okay, this is definitely a bullish pattern. And right now, since back in October, you have a series of higher highs and higher lows, which is the definition of an uptrend. Okay, so this one does look constructive. Anyway, I don't want to get too bogged down in that kind of stuff. I don't really.
Great.
I could go on and on for years about this, and I plan on doing so, but not at all. Not everything today.
Wealth of information. So Romulus, I do have some questions. Let me go ahead and I'll moderate them for you so you can just stay focused on your charts and stuff. But
sure.
Quick question. I'm just going to go through the list here. I got a question if just want to get back to the beginning. Okay, so a question from John. Do you set up a scanner based on your RSI and other factors to find trading opportunities?
No, there's a reason for that, John. There's an understanding that something that's handmade is better than something that's machine made. And yet we're always trying to machine make things, and we think it creates a higher level of efficiency. It's kind of like that for me. Looking at the computer chart, allowing TradingView to actually draw the chart for me, as opposed to what the teachers who taught me, like Ralph Acampora, they drew their charts on the wall with pencil when they came to work every morning. I'm going to let the computer do that for me, but I'm going to run my chart scans manually. I'm going to do that by hand every day. I'm going to look through hundreds of individual stock charts and dozens of ETF charts and dozens of futures charts by hand. because that keeps my hand on the pulse of the market. That's me. Maybe that comes from the fact that I started doing this in 1994 and evolved into a world that was kind of pre-internet and pre-automated everything. And that's what I'm good at. Maybe not. I don't know. But I feel that that's the best way for me to keep my hand on the pulse and keep that feel of the market, because you do need to develop a feel. I mean, Troy and I could teach you everything. If we were to do a data dump from everything we've done for combined 60 years into your mind, and now you have all of our abilities, I get that that would be a great opportunity, but there's still a way, a feel that you have to develop, a touch, and that comes with practice. And it just comes from practice. So looking at charts every day by hand keeps my skills sharp. So I know I don't have an automatic screen that just runs through these things. But I'm in the process of possibly developing one for the individual stock basis that might help on the like the IBM trade or the Crocs trade, because I think that a lot of the people out there are not trying to do the same level of work that I do. So yes, Troy and I will work on that for you guys, and we might be able to bring something like that to you. And what do you say, Troy? By February of this year, maybe we can run that out to everybody. Something like that we can do.
Well, we're definitely going to
Yeah.
offer something which we could talk about. But
Yeah.
I
Yeah.
wanted to elaborate a little bit because you hit upon a point that's really, I've been echoing it forever. And that's the idea of automation versus manual back testing, which, manual back testing, I'd rather sit in the dentist chair and get a root canal than manually back test. But really, what you just said, having your fingers on the pulse of the chart and living with your chart and the price action and what you learn from that experience cannot be duplicated. A lot of people ask me if I run Counterpunch Trader on a scanner, and the answer is no, never, because what I want to do is prove that it will make money on a specific chart over the last 100+ trades, because then I know that the trades going forward have a better chance of succeeding as well. And
Yeah.
like this, I eliminate charts. Like Counterpunch is going to work on everything, but the ones that it continues to work on, that's what I focus on. And you're not going to find that in a scanner, at least that's not how I've ever done it. Because then, so you scan something and a trade comes up today on some symbol. How do you know that it's just not a John Wayne shooting from the hip, whatever? You don't know if it's going to win or lose, or what the win rate is over the last 100+ trades, and if the odds are on your side or anything like that. So for me, I'm
Right.
not interested in that. So let's just continue with these questions, Romulus. We could talk about what our plans are near the end. I want to try to keep this within an hour. We're getting close to our hour. Dawn asks what the criteria for extreme overbought and oversold is for you.
Okay, so let's go back to the IBM picture for a moment. And you can see that obviously the stock has been running up aggressively and powerfully for the last several weeks. Typical technical analysis explanations of an RSI, if we're going to use that as I do, is 70 or above on the 14 period is overbought, 30 or below is oversold. On an individual stock, though, versus an index or a sector ETF, I'm going to push that even further. Okay, so the RSI 2 extreme is 90 or above, and the RSI 14 is 75 or higher. Okay, on the sectors like S&P 500, for example, I'm going to relax that a little bit, but you can see back here, right? Look at that. The RSI gets about 76. So you can still use that as a 14 period. And then you want to see the RSI on a 2 period above 90, 85, 90. And that's an extreme level. And then it starts to pull back, or you should expect a change of momentum, maybe slowing of the upside or sideways action, trading range, which happened here before the downturn, or just a downturn right away. So again, in the RSI 2, it's 90 or above. On the 14, it's probably 70 or above on the indexes, 75 or higher, maybe even high 70s on the individual stocks. And an oversold basis, and that's to come into play a little bit too. Is the market above or below the 200-day moving averages? Markets are in bull or bear markets? Remember, in a bull market, overbought can get more overbought. So extreme on the upside has to be given more of the stretch. And in a bear market, oversold stays oversold. So you want to let that stretch even further. So you have to apply a little bit of logic and common sense to that as well when you're looking at those parameters.
Great. Yeah, that's a lot of insight. Just because the market's oversold or overbought doesn't mean that the trend is going to reverse. The trend is still your friend. It's still what's prevailing strength, and until proven otherwise, we're in a bull trend. I mean, we're in an uptrend. There's just signs of additional risk as our noses begin to bleed more, and there's some divergence, and there's all these the soldiers not keeping up with the generals, so to speak, right? I love that. Love that metaphor. So Darko asking if you could pull up AMD and give your commentary on that.
All right. So AMD was a powerful breakout here from this kind of long flagging pattern back here. But now it's been underperforming for a bit here. But if you start, first of all, start with the NASDAQ, okay? Like the Qs as an example. It's been underperforming the S&P this year. Okay, S&P is up 27, the NASDAQ and the Qs are up a little bit less than that. Versus 2020, S&P was up 17, the NASDAQ was up almost 50. Big reversal of fortune there, okay? But now we go drill down a little more into the semiconductor group, and this has been doing well, okay? But it's not been keeping up with the S&P 500 since back here in November. So it's starting to lag, and these things they start to have more weight over time. It's starting to lag, and you go to AMD, you see what I'm doing? I started high and I'm going down. I started wide and I'm narrowing my analysis. Now I'm in AMD and I see stronger underperformance than the S&P and underperforming the group and the sector, okay? So this stock is setting up for possibly further downside action over coming weeks or months, and it could take all that time for it to unfold. On a more specific basis, it does seem to be having some fortune with the 50-day moving average lately. So a break below that would possibly spell that trouble that is being foreshadowed by the other conditions. The volume hasn't been good since November 8th. That's the last time you had a good upside volume. Since then, the downside has been stronger than the upside on net on average. Okay, and again, don't commit SIM, which is a single indicator mistake. You want to look at indicators, especially volume, on a broad basis, on a several day, several week basis, which is why I have a 50-day moving average over that. So overall, it looks like AMD is preparing to underperform the group, which is preparing to underperform the sector, which is preparing to underperform the S&P 500 for the time being.
Yeah, I want to point out too that that's also looking like a classic head and shoulders possibly forming, and if it breaks below that 130, watch out. Is that red line your 200 EMA?
Yep.
So, I mean, that could be a potential target if things get ugly. So we're not there yet. I mean, I wouldn't even say that. We could still test those highs and go higher. We're still in an uptrend, but the signs are there that caution is probably a good idea. Don asking if you could unpack your negative divergence concept and how you identify it.
Okay. All right. So let's go into S&P 500 in here. So let me see. I'm going to utilize something. All right. So here's a good example. Here's a positive divergence. Okay. You see that the price is here back in September, and the RSI. Let's use the RSI 14. Okay. The lowest the hit was 33, and then a couple weeks later, price goes lower, but the RSI is at 34. Now that might not seem like much. It's not, but when you combine that with the positive divergence going on in the RSI 2, and that's drawn in by my trend line right there, and you can see the positive divergence in the CRSI and the slight one in the RSI 14. There was a lot of data presenting itself to suggest that that was some kind of a trade, at least tradable low, and it turned into an investable low. Okay, that's one example. Now you said a divergence, so I'm going to go to February, early 2020. Okay, so here I am in early 2020, late 19. You can see the RSI at the 14 period. We'll use that one because we're looking at intermediate term work. It's a 78. Market goes higher. It's a 76. Market goes higher. It's a 66. Market goes higher. It's a 65. So what's happening? Price is going higher and higher. This is just to show you that price is going up. Okay. Well, hang on here. All right. And the RSI is going down. Okay, it's weakening. It's showing a slowing momentum. And momentum can only slow so much before you get a reversal. That's the idea. That's the theory. That's the concept. And that's what I do a lot of my trading on. So this is a classic example of RSI demonstrating an approaching top. Price goes higher, RSI goes lower. And I found the same thing in Bitcoin. I was actually the only one in the entire world to accurately identify the top of Bitcoin back in March, April of 2021. And I was able to do that through RSI work. Okay. So here you can see the RSI peaks right here in January, and it goes a little bit lower, and then it gets a little bit lower. But price goes higher and higher. Okay. All the way through here. By the time it peaks in April, you see the RSI is nowhere near the levels that it was at over here. Okay. So that's a couple of examples of negative divergence and an example of a positive divergence that proved to be quite effective when it comes to intermediate term trading. And you can narrow your time frame down to whatever level you want and still find this to be effective. I know people in my group that use this on hourly charts and 15-minute charts, and they find that it's just as effective as what I'm doing for intermediate term trading or short-term swing trading, as an example for my Firmus model. It's just I don't day trade. I don't day trade because I'm out there, I'm doing other things in my life, but they find it to be very effective. So you can just shorten your time frame and get similar similar results than as what I get here for my swing trading and longer term stuff. That's a great question too. Troy, anything else?
Yeah, a few. That was a great explanation. That's looking like Bitcoin sitting right on its 200 moving average too. And if you look at the futures, you see it kind of flirting with that level, and it's been holding. Except now it's looking really toppy, and if I'm waiting for Bitcoin to drop, hoping that it will, so I could pick some up at a lower price. But anyway, I'm keeping my eye on that 200 moving average, and I'm watching the futures contract with that because Counterpunch works on that. So obviously that's my go-to. So a question from John: if we're consider doing a Romulus chat in our Backpack Trader Discord club, just having a separate side channel, and yeah, that's a pretty good idea. We'll probably do something like that. I like that idea. Bruno asking what your thoughts are about gold.
Okay, all right, let's dig in here. So first, change it to a weekly. Okay, and you can see gold's a pain in the neck. All right, it takes so it peaks out. I bought gold from 1999 until 2006. Average cost about $435 an ounce. Sold it all in August of 2011 at $1,900 an ounce, $22 away from its highest level ever. Then it goes to that long bear market, right? Long, 9 years it takes to break to a new all-time high. Now, my buddy Ralph Atkimpora told me that the reason he was able to get that Dow Jones 10,000 number right is because way back in the early 80s, the Dow had spent 14 years consolidating around 1,000 and pulling back. In 82, it breaks above. And by the way, that's what he was talking about, from that level up to 10,000, almost 20 years later. But the longer the base, the higher in space. And I thought a 9-year base has got to be a lot of time up in space. This thing's really got to go. It hasn't. It's been in this flag thing, and flags don't normally last this long, so I can't even call it a flag anymore. But it's been in this pullback nonsense since August of 2020. So you got 16, 17 months here that it's been doing this. This is nuts. Okay, this is absolutely nuts. Gold should be higher. I don't see anything in the chart that's suggesting, because it broke out from this triangle a couple of months ago. It didn't follow through. It pulled right on back, but it pulled back to the top of the line. So that might be something. One thing I feel though, that if Bitcoin didn't exist, if there was no digital currencies, gold would already be at 3,000 or 4,000 an ounce. And if there weren't 15,000 different cryptocurrencies, if there was only Bitcoin, Bitcoin would already be at 1 million. In other words, there's too much competition right now for the money that might go into gold or just those gold and Bitcoin. There's too much competition. And there's only a fixed dollar amount in the world, as we know, although the feds and the other central bankers believe otherwise when they get silly with their interventions. But there's only a fixed dollar amount, okay? So gold should be higher. It's not. I don't see anything technically that's telling me that what should be going on is about to start happening. This breakout took 9 years to produce. We should get follow through by now, but it's not falling apart either. So it's a tricky one. I don't know.
Yeah, valuable insight there. You have to let the price action speak to you. It's telling its story. There's a conversation going on. You just have to listen to it, and you just don't fight the tape. I mean, it is what it is.
Yeah.
Good question by Hardy. I think I'll take this one. Hardy asking what are our thoughts on trading the weeklies with the SPY or the SPX with Counterpunch Express or Counterpunch Trader and overbought and oversold. So it's an interesting idea, but there's a couple things that come to mind. First of all, for me, I don't have a lot of experience with weekly options because it's just not my forte. And if I'm going to do quick trading, I'm focusing on futures contracts. So I don't know. I couldn't tell you. I think in concept it could work. Counterpunch Trader also has its own way of looking at overbought and oversold. It's pure price action. It identifies exhaustion levels and then balance of power and then closing on either the lower side or the upper side of the balance of power in conjunction with who's exhausted and where the price action is leading. So it could work, Hardy. It's a matter of finding the right chart to signal trades to trade weekly options. It would be some sort of a real short-term swing trade, probably bigger than a day trade chart. And I don't know what that would be because it's just not something that I spent time with. But you can use the 3-step sniff test. You can back test it. You could use all the techniques that I teach with all my strategies, and that would fit like a glove with chasing down your own idea. And I would encourage you to do that and then share it with us, because if you discover something, you might get more traders interested who might jump on in and help with figuring out your idea, because it is a pretty interesting idea. Romulus, I don't know what your thoughts are on trading fast oversold and overbought conditions with weekly options. Any thoughts on that?
Well, again, you want to make sure that you're using expiration dates that are far enough away so you're not taking on unnecessary risk. Second, I've recently started doing a sector rotational trading method using the major ETFs, about 50 of them, that uses only weekly changes. So Thursday night, look at the update and then trade it on Friday if it needs to be traded. So it's kind of changing weekly. So yeah, you can do that. It does slow down. You should have less trades if that's what you're doing, which is good. You should still have good results of mid-20s or so on a yearly basis, annual basis, which is great. So I think that's appropriate.
Yeah, good. So yeah, and for me, I'm thinking, fast trading with options seems a little complicated. I guess if you have a really great symbol, a great chart, whether it's an ETF or a stock, those are some great trading charts can be found on different time frames, and that might be an argument to do some fast trading with a weekly option where you're just planning on getting in and getting out. But to me, that's falling into the day trading category almost, in which case futures, I mean, why fight it? We know that futures work so well. You get in and out so easily with the click of a button, and the strategies work well too, and you could prove the trade plan and know you're going to make money. So it's just, I don't know, the fast trading with weekly options almost seems to duplicate what we're already doing with futures. On the other hand, I don't know. I mean, I'm open to the idea.
Sure.
I just don't have any feel for it. off the top of my head, other than what I
Right.
said. So a couple more questions, and then we're going to wrap it up. Hardy saying thank you, Happy New Year. You too, Hardy. Great question. Thank you for that. Um, Dennis, I'm going to answer his question. He's asking, when you short or go long, did you have your RSI 14 overbought or oversold? So when it's overbought, you're looking to short. When it's oversold, you're looking to go long, provided you have other corroborating pieces of information. Is that correct, Romulus?
Yeah, that's right. You're looking for the opposite, the inverse trade there. Okay,
Right.
you're looking to buy weakness in an uptrend, in an already existing uptrend, or short temporary strength in an already existing downtrend. That's the basic premise.
Exactly. So it's like, talk about counterpunch. That's a counterpunch type of trade. Counterpunch trader does the same thing with one of its setups, the white trade, which looks for the exact same thing. It's looking for overbought and oversold conditions and counterpunching, and it'll often get you in front of a really big move early. Sometimes it gets you in too soon, and we have to use money management to exit the trade. A question, John saying, your thoughts on silver, which is acting different than gold.
Well, let's see if it is, right? SILVER, silver. I mean, I don't see this acting much differently than gold. It's stuck in this, trading range, not really breaking out, not really breaking down. I guess I need clarification as to what you mean by it's trading differently than gold. I mean, they both hit that high last August of 20. It's kind of stuck too. Yeah, it's kind of stuck also, unfortunately.
I will say over the years that both the ETFs of GLD for gold and SLV for silver have performed very well using Counterpunch Trader for short-term swing trading.
Yeah, you can get the signals, and the ETFs that he mentioned. Again, making sure you're utilizing proper money management techniques and tactics can be effective, because you can find, let's say gold as an example. Look here, it drops and drops and drops, and then the RSIs on the short term get oversold, and then it bounces. Okay, you find those trades. They're out there too, and they're out there with all commodities. But there's a difference between stocks and commodities. It's something we can talk about another time, that you have to just be aware of. That's all. You have to be aware of the differences.
Yeah, risk being one, because you can't go smaller than one contract on a futures contract, and they also expire.
Right.
Whereas a stock, you could just buy and hold and
Whatever, yeah.
just ride it out. Yeah. So, and you could also scale your position. So that kind of brings us near the end of the questions. One last question, I guess, from John. What does Romulus think about seasonality on stocks like DPZ rallies every December through April, or any sort of seasonality things that you're thinking about or looking at or whatever?
DP's Domino's Pizza. That's a great company. And I didn't know that it rallied from that period of time. But yeah, seasonality does play it has a powerful effect on the markets. If you looked at November of last year, it was the greatest month in stock market history on a global basis, not America. It was the third best month in American history, but on a global basis, November of 2020 was the greatest month ever in stock market history forever.
Right, and but wasn't that when they said we got a vaccine for COVID?
Sure, I mean, but look at this. November is tied with April as the strongest month of the year on average. And the best month ever happened during November. So that's probably not a coincidence. I don't believe in coincidences. Right. There's just a lot going on there, right? And December is usually a pretty good month. The summers are usually a little bit weak. September is the worst month of the year, and September this year was pretty bad. Last year it was bad. So yeah, seasonality does have an impact, but that's not the first thing you need to go to. You need to go to price and volume and just good old-fashioned technical analysis, and roll up your sleeves and look at some trend lines and some moving averages and let it play out, because you don't want to fall into it that just seasonality is going to get you into or out of a great trade. Because what if it works 7 times out of 10, but you just fell into the 8, 9, 10 times?
Right. Yeah, let the price action talk to you.
Yeah.
So we've kind of gone about an hour and 15 minutes. I think that's okay. We went a little longer, but hopefully you guys enjoyed this round the coffee table discussion, real casual. just trying to share some trading insights with you. Thank you guys for hanging out with us and asking some great questions. A couple things to look forward to down the pike here, especially early on in 2022. Romulus and I are putting together a few things. We're going to have this training course that we're going to put together and make available soon. Romulus, I don't know if you're ready to speak on that now, or if you want to drop a little teaser on what we're thinking about, but I'll let you kind of put it in your own words if you'd like, or if you rather wait.
Absolutely, absolutely. So a couple of things. First, again, I've been teaching from the word go, okay, from when I got involved in Wall Street and on since. And people tell me the same thing. It's the same message, and then there's other details, but it's the same message that what we teach is it changes their lives, and we can do that for you too. So one of the specific things is for me is I want to teach people to the point where they can fish on their own, okay, not just give you the fish. And that's important to me. Yes, we want you part of the group. I'm part of the group. I don't want to not be part of the group. It helps me. It keeps me sharp. I stay improving that way. But if something happens and I can't be part of the group, I can still do this on my own. The level of confidence that you'll have as well. So we want you to actually learn the inner workings of what this technical analysis really is. And I'm going to be teaching a class here soon down the road a bit, which is going to be based on the Wyckoff method, who was one of the greatest technicians of all time. He was teaching and living 100 years ago. And Troy's probably learned a lot of his stuff as well over the decades. But that's something that we're going to be teaching. And then, of course, there's the whole Romulus Club as well with the trade alerts for the ETFs. And I have another package that comes with that for it's an ETF model that more catches trends that we'll be releasing as well. So there's a couple different things that we'll be talking about in detail and how you can be, involved with what we're doing and stay close to the Troy Romulus action. Absolutely.
Yeah, and I'll just add to that I'm also pursuing, and I'm really interested, and we'll be giving you more information at some point in the not too distant future about a possible stock and options alert service that will rely heavily on the counterpunch trader and some other tricks that I've got up my sleeve that you guys don't know about yet. And so that'll be something to look forward to in 2022 as well.
Yeah.
Along with, of course, the up and coming Catapult Russell Boot Camp, which is going to be, I'll be announcing when that will be held. It'll be in January for sure. The only reason why I haven't announced a date for it is because I'm lined up for the Wealth 365 event. I don't know if you guys are familiar with that, but that happens every like 3-4 times a year, every quarter, I guess. And I've kind of shied away from it for a while because it's a lot of effort, a lot of energy, and I was always busy with other things, but they kind of talked me, my marketing team got together and they kind of talked me into participating in this upcoming Wealth 365 event. You guys might want to get registered for that. If in fact, if you're interested in that, maybe go to the Trade Hacking Club and Discord and just let me know, and I'll see if I can get you guys a registration link. That's a week-long symposium with all kinds of traders and gurus and what have you, and you can learn a lot from that. So they want me to come in and talk, and I'm going to. They just haven't given me a date yet, and that leads me full circle to why I brought it up in the first place. I haven't announced the Catapult Russell Boot Camp yet because I want to do it around the same time as Wealth 365, around the middle of January, and until they give me my time slot, I don't know what to work around. So I'll be announcing the Catapult date soon. It's still not too late to get on board the Catapult Russell Bootcamp if you're interested. Catapult's been amazing. And just to give you guys a little bit of a rumor, some whisper, what I've heard in the background here, rumor-wise, since you're here, I'll share this with you, is that there's going to be some sort of a Catapult trader, swing trader sector boot camp that we'll be working on too. And that could be an interesting way to use the weekly options idea that
Right.
that we were talking about earlier, because that's a quick hitting scalp and run style of strategy, as you know, and it will work. I'm learning the more I research it, that it's going to be really good for swing trading as well as the day trading we've already been using it on. So we got a lot going on. And then there's things that I haven't even let out any whisper or rumor information on that I'm working on too. And I will let you know about that later as I get closer. But I am working on a brand new strategy, which I'm really excited about, but it's just too early to share anything with it. But we're always working behind the scenes. Romulus and I have things that we're working on too, and we'll be letting you know about that. And we'll definitely have more of these types of sessions as well that you guys have to look forward to.
Yeah, that sounds great. That sounds great.
Yeah, so Romulus, thank you so much for sharing your time. I know you're a busy guy and getting close to New Year's, and I know Romulus is on holiday time. We both are. This is fun for us. We're not really working much this week, trying not to anyway. But next week, we're hitting the ground running to just get a quick jump out the gate for 2022.
That's right. That's right. So thank you, everybody. I appreciate your time. And I am echoing that, what Troy said. I'm looking forward to all the great action that we're going to be collaborating on and helping each other with for the 2022 and the decades beyond. So thank you very much. Happy New Year to everybody. And I will see you soon, like next week.
Fabulous, Romulus. Take care. And everyone have a wonderful New Year. Stay safe. And we'll be interacting. Any questions, put it on the Discord channel. Certainly be answering them all. And until we meet again, everyone have a wonderful last few days of the year. And again, Happy New Year. Have a glass of champagne for me. Bye, everyone.